Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, October 18th, 2022. What I'm going to do here is follow up on the post I got out to you this morning, talk a little bit, I'll just start off here with that analog from 2008. Remember, I've covered this quite a bit lately. Early on, I was expecting and highlighting the bear market to play out in similar fashion. I mean, the basic straightforward stuff, which is an initial leg down, how the move would play out, dip buyer step in, you trade these divergent lows. Again, this is 2008 we're looking at here, but most importantly is these rallies back to keep Fibonacci levels, 200-day moving average. Everything's we had same thing back this time around. Remember, I'm looking here. The top was October of 07. The bottom was November of 09. Well, March of 09 for every other index, but as I mentioned, the NASDAQ was the outlier, bottomed in November, but effectively a double bottom because it had a hair higher. But like I said, at that point we traded those. We did those same two. Here, I'll show you what I'm talking about in case you didn't catch those previous videos. We did the same shorting the pullbacks or the bounce backs. I'm sorry, to the 200-day moving averages. Of course, we're using a black chart here. This is the high back, just like then. We were shifted forward about a month. The NASDAQ this time around peaked in November. Early November instead of early October like back in 07. But everything else is played out. You could almost mirror those, cut that chart and paste it to this, both time, scope, meaning the distance of the drop or the amount of the drop, and then of course these rallies back to the 200 days in proximity there, key Fibonacci levels and everything else. So that is, again, the analogy I use, it's like a shopping mall. You look at the map and it's the "you are here" thing. However, I did have said it all along that early on, that's kind of straightforward stuff. When trend indicators slip and you take out the 200s, you want to short bounces back to the 200s. I mentioned how it's more than common to see you on a day, maybe even 2 or 3 days, take out those 200s by a small margin, and then usually only to see you close the week back down below. That's what happened back then. We had a slight cut here. And again, I'm using both the 200 simple and exponential. Now, but what I've said all along is, this bear market is a lot different. It's different for different reasons than the previous bear market. In that bear market, we saw the Fed starting to ease. At this point in time, they were already cutting rates. Now we're raising rates. We have just different dynamics in the whole macro, not just in the U.S., around the world. So as such, I don't expect this bear market to play out the same. I think we're going to be in a much more prolonged bear market. That one was only about a year and a half or so. If you blinked, you missed it. It was powerful, 55% or so drop in both the S&P and the NASDAQ. But this time around, I think it'll be a much slower ride down. And with that, and the takeaway is, a swing and trend trader should actually flourish in a market like this, because you're going to have plenty of bear market rallies along the way. We've already had two. The first one was about 17%, and the second one was better than 22, 23%. And so those are going to come. Now, the million-dollar question, this is why I'm doing this video. Is this the next one? As of this very moment, you have to take it on face value. But again, and I can't say this enough, the charts are dynamic, and so is my analysis. So right now, yes, we're back above 270. I keep referring to it as 270 because you like to round up, benefit of the doubt. You had one intraday pop over that level recently. And so, the previous low was exactly, I'm talking the June low was at 269.28, so we'll call that 270-ish. And, that's a breakout. So here's how you have to look at this now. As of now, we had the downtrend line right there. You have a breakout, and we could back test. We could back test the trend line. We could back test the 269 to 270 level. Anything much more than that, you break down, then it's a failed breakout, and that's very bearish. And that could set us up. And again, I shared that analog from 2008, which I'll get to back in 1 second here, because things can happen in a similar fashion. I'm not married to the fact that at some point these analogs are going to disconnect, maybe something similar. Now, you're not going to look for the exact percentage gain of the bear market rally, or this one could most certainly play out as the real deal. Again, there comes a point where, before we were back testing and failing to get back above the breakout. So I was taking that on face value recently, the fact that we took out the previous low and we were back testing from low. Now we recovered it. So I'm going to take this on face value. I mean, I'm flip-flop. I had two lots of NQs taken out last night while I was sleeping. So I'm already scaling out, not by what do you call it? That's not intentional. But from here on out, I'm going to, wake up, then I can manually control my stops. I pulled the rest just to not get popped. I had one that would have been clipped in the just before the market opened if I didn't pull that. And that goes back to, if you're wondering what I'm talking about, that's that 10-minute chart. So if you remember in yesterday's video, I said this is my active trading time frame, the 10-minute chart. The last divergent low was right here. And yesterday we were starting to move up, but we didn't have negative divergences. And so I said this is probably where we'd carry up to that 11,355-ish level right there. And the fact that we did, and then we had negative divergence, that raises the odds for a pullback. And so, I'm trying to fire off that post to you, but let me explain what I mean by here. This is, I fired this off and that should have expanded. When I say something is likely, I'm a pretty literal person. So likely to me means anything that has more than a 50% chance, right? Coin toss odds are 50-50 if there you can make an equal case. Unlikely is less than 50% chance of an event occurring, and likely is over than a 50%. But when I say it's relative, the gist of what I'm saying here is likely is not highly likely. It's just likely. So just a little bit better than a 50% chance is what I'm referring to there. And again, that's what I should have expanded on and realized after I got that off and reread it, which I often do. I'm that person that sends text and then I read it after for whatever reason. I'll glance at it and notice all my typos or whatever. And so anyways, I often do that with these posts, and I'll usually credit or correct typos and let you know, or if any levels are wrong, I'll put that in the comment section. And still haven't fully reread this one. But the primary takeaway is, take it on face value. This is a powerful gap. The price action the last few days has been bullish. And yes, when we had the one-day big move recently, I said that's normal in a bear market. When you have several of those moves in close proximity, then it starts to increase the evidence that you're going to have a more lasting rally. And not only that, let me be even more clear on that. Let me expand again. So I don't care if we were up 5% today. If it was only to take us back to resistance level, I would say that's an objective shorting area. When you're up, whether we're up right now, we're up 2.3. This is QQQ right here, 2.3%. We could be up 1%. And it could be bullish because if that 1% took us above the 270 level. So this is more than enough to take us. We're clearly above it. It'd have to be a heck of a fade. So that's what I'm looking at, is that a big move in a bear market can either be nothing to me. Again, if it's technically doesn't change anything, if it's just a rally back on oversold conditions and a rally back to resistance, it's actually to me a great shorting up. However, a big move in a bear market or any move up can be technically significant, and this one is technically significant. All right, not to beat a dead horse, just want to point that out. So take it on face value, and at this point in time, the way I look at it is any pullbacks to that level would be objective long entries. Now, if you are short, let me talk to that too, because there are people that take the longer term approach, and at times I'm doing that in my long-term accounts as well, and still am. I still have, believe it or not, some shorts. I wasn't stopped at everything in those IRA type accounts and all that. Some of those I have futures. They let you trade futures. A lot of traders don't realize this. Not every broker, but Interactive Brokers, you can actually short futures. You can't short stocks, you can't short ETFs and IRAs, and you can't short futures in every account, but with Interactive Brokers they have margin IRAs, and I love that because A, the leverage, number one, first and foremost, and B, and the leverage, by the way, there's two ways to use leverage. You can use it to hang yourself over leverage, put everything into one security and bet the farm on it. Professional traders don't do that. If you don't trade diversified, you're going to be wiped out sooner than later because nobody bats 1,000. So, but what the diversity will do, or the leverage will let you diversify among various positions, and so you can build a portfolio with a lot more exposure to the overall market. And when you're hedging, one thing tends to go up when the other goes down, and hedging is capital intensive to effectively hedge. Meaning, if you whatever your number is, you have $100,000. You want to put it into QQQ. If you have a $100,000 portfolio and you're non-leveraged, you don't have any leverage, you can put in 100,000 long or short QQQ or the Nasdaq 100, but then you have nothing to stack against it. Whereas if you have a leverage, in futures a 10-to-1 leverage factor to begin with, typically the index ones, you can then go long or short 100,000, but then put 100,000, 200,000, whatever you're hedging with, against that as a hedge, and so it works that way. Now. And the other benefit too, to me the biggest benefit is around the clock stops. That one I can't impress enough. It prevents this kind of stuff, waking up when you're only trading ETFs or individual stocks to a big gap. And what gaps do too is they really build on themselves. And then the worst thing to do is have a standing stop loss order on an individual stock or an ETF on a big gap day, because it's called order imbalances. At the open, a stop loss, you need to understand how orders work. Stop loss and stop limits are two different things. Stop loss says, okay, let's say you were trying to manage a risk above, let's say 270. This is a great example. I'm sorry I'm digressing, but I always talk about this from time to time, how these stops work. So 270 was a level, we were flirting with it yesterday. So let's say you like to run tight stops. So you had a stop there at 271 in QQQ. And it was a good to cancel stop loss order. Well, guess what happens? That says, well, QQQ, those orders don't get, stop loss orders cannot get triggered in the pre-market session. Only stop limits, only limit orders. So stop loss order effectively becomes a market order once that price has been hit or crossed. So 271 was never hit or crossed yesterday. It was crossed this morning, and what happens is everybody and their brother who had stop loss orders, all their orders immediately convert into market orders at the open. That's what's called order imbalances, and that's why I don't use those. And if I have them on a day like today, I would have canceled it on an individual stock or ETF on QQQ, because you don't want to be in line when they all fill at once. Order imbalances means there's too many buy orders. A short seller has a stop loss order. It's a buy order, buy to cover QQQ. Or same thing if it's a sell order on SQQQ, which is the inverse. It's also just doing the same thing. It's buying the Qs. So all those orders get piled in together, and then once those order imbalances abate, meaning there's a balance between buyers and sellers, you usually get a fade of that pop. So just lesson learned, because you're just going to grind yourself out if you're using stop loss orders and you have these in a bear market, because gaps are very common. Now, of course, this was technically induced. That's why I fired the post off to you before the open. The futures had drifted up right to that first decent support level there, and did so with the divergent high. And again, it's wash, rinse, repeat. That's our last divergent high right there. There was one right there. There was a divergent low. There was a divergent low. So again, swing trading, active trading time frame, and I'm just trying to look here. Yeah, you know what? I'll add a line to this. I'm just kind of ad-libbing this video here, and I want to get back to some of the other things. There's a reaction high there and a reaction low there. It may be a relatively shallow pullback, but I had us go into at least this trend line here in that scenario I gave you, possibly this one, and maybe more. Now let's turn back to what I really wanted to get to, but I think that whole little side thing I just did on stop loss orders is very useful to know. Again, so this was that analog. This is what I got out to you earlier today, and just in case you couldn't make heads or tails of what was in there. This was, again, the same, very, very similar price action to where we're at today versus this chart, which was back in 2007. There was October 2007 top. And if you zoom in there, this is what it shows. I created this chart years ago to go back and reference. If we don't have a lot of bear markets in recent history. We can go to this one. We can look at 2000 and the dot-com bubble. It popped in March of 2000. That market bottom in '02. But again, that was a completely different bear market itself. The fundamentals, the macro, even the technicals were a lot different from this one. So this one here has the closest parallels in modern history. Or I guess now, when the macro situation, you can probably go back to this bear market in the early 70s, from I think it was 68 to 74. All right, so what I wanted to show you and what I did show you, this measurement here shows that remember that divergent low I was talking about, going over these analogs that you had. Just like now, we're down about the same amount over the same amount period of time. The seasonality even matches almost perfectly. And back then you had nice positive divergence on the weekly, on the daily, on most of the key stocks and sectors, just like you do now. And as I've been talking about for the last few weeks now, that divergence failed to play out. Now, it didn't completely fail to play out. It started to play out, and if you look real closely here, I know you probably can't see it in the video, but you can go back and check that, from the divergent low, which was right here at this point. Let me see if I can zoom this in a little bigger for you. Having a hard time. Hold on once. Okay, there it is. I zoomed in for you. So there's that divergent low. And that was a reversal one day and a pop the next day. I might have missed that measurement. You can see when I zoom in this tight. Maybe that line should have been a hair lower, so we'll call it 10%. That happened in just, it looks like a day or two. This is a daily chart. And so that was a 10% rally. And so again, it looked by all accounts, just like now, like the divergence was going to play out. And then all of a sudden, it got sold into. And yes, I'll have to scrub the dates. This was around the time of Bear Stearns, Lehman, and all that. That's what really started getting the markets going and had that final wave down. Because I will maintain what I've been saying all along, guys, that remember, I did a video about a week ago. I don't want to use the word pivot. I hate that word, but maybe a soft pivot, or at least a recognition of quite a few indicators, sentiment indicators included. One of my put to call ratios, the weekly, hitting my buy zone, stocks trading above their moving average, 50 and 200 days, some market breadth indicators, new highs, new lows, things like that, where some of those indicators were actually looking bullish, but not all my indicators. And the one thing lacking so far in this bear market, and I have, there's no certainties in this thing, but I have a pretty high degree of confidence whether it's coming soon or it's coming months from now after a nice rally, which we could be looking at here, that we haven't seen any capitulation type selling. We've seen some pretty big downs in the market, but nothing like panic selling, and we haven't seen the VIX or the majority of my put to call ratio, my best sentiment indicators, have not hit those buy levels that they've hit in previous corrections in bear markets. So I am very open to this. Now, if you're confused, Randy, you're all over the place, how do you play it? It's easy. It's easy. Take it on face value, because this may or may not happen. Don't let your losses continue here. Let me get to today. We know what happened back then. I already did that. Let's go back to today. 1 second. Okay. So, if you are short, don't let your losses mount up. I'm going to watch this weekly chart. Remember, I told you the first thing that would be a check mark for the bulls would be a daily close above that the previous lows, call it 269, 270. Right now, it's looking like that. They'd have to have one heck of a fade. That means if I measure from where we're at now, just to back test that level, you have to drop 2.5%. So to get solidly below it, it's going to take about a 3, maybe even 4% drop. Okay, so that's probably not going to happen today. And if it does, jump on it. It'd be pretty bearish to see this whole gap faded. The other thing is a weekly chart. Remember, we're still just getting going. Earnings season's been going on now for a couple of weeks, but in the beginning, the companies aren't the needle movers. Right now, the financials, they're not what they used to be in the S&P 500, and they're actually nothing in the NASDAQ 100. The NASDAQ 100 doesn't have exposure. It's one sector it's lacking. It's mostly tech stocks. Techs are the market. The financials are dwarfed, their market cap. Even the mighty JP Morgan is dwarfed by Apple and Alphabet and Amazon. And so they have the biggest impact on the market. Now, the financials are important. That's what broke the financial system back in 2008. This time around, it's like I said, it's always going to be different each and every time around. They're in better health right now, by all accounts, than they were back then. Less leverage, bigger loss reserves, and all that good stuff. So the shoe's going to drop. If it is going to drop, it's going to drop probably from somewhere else, although I have talked about systemic risks right now in the financial system due to everything, spiraling treasury yields, a parabolic U.S. dollar rate of ascent, the UK gilt market imploding, their public pension funds imploding as well because of that. Ours next shoe to drop. So the risks are there, and yes, those risks do permeate and will, I believe, are very likely to affect the financial sector. So I need to backpedal a little on what I just said. Just because the banks have larger capital loss reserves doesn't mean that the banking sector is not at risk at all. I think there's tremendous amount of potential risk right now in the global financial system. All right, back to the charts. So again, take it on face value. It's a breakout today, but if it fails, just like back then, just react to it. That's the way I look at it. So I gave you these resistance levels the other day on QQQ. Remember this one here, we entered a gap. There's a gap right there, but we entered that gap and went above it because of those order imbalances. So we fell back below it. So to me, this is simply a reaction at that predefined 275.25 resistance level, which is the roughly the bottom of that big gap from right here, and we're below it right now. So the way this works, this technical analysis, gaps act as resistance when tested from above and below. Gaps once usually entered are backfilled, but not this. This is why I am not a mechanical trader. You got to override things. I've got that chart post out to you this morning, telling you I expected a fade because we're at resistance on NQ. And again, the only reason we entered this gap, in my opinion, is due to the order imbalances, because the futures had moved so much last night, and then boom, at 9:30 a.m. all the short sellers that had stops got their stops hit on QQQ, relatively speaking, of course, and other stocks, Apple, Amazon, all that other stuff. So now the initial knee-jerk reaction, the order imbalances, is over. So here, let's just look at this way. We are now under, let's just say we rallied into resistance. The fact that first 60-minute candle is only a 30-minute candle, really. We're below here now in our first full 60-minute candle of the day, and there's your resistance right there, the gap. So they either fade the gap. So if you shorted the open based on that 60-minute or 10-minute chart I got out to you today, you could certainly I think it's not a bad idea. Again, this just comes back to trading style, risk tolerance, where you think we're at. So if you got a short off this morning, or at that level, or sold longs, you could let it ride for a much bigger drop. Or you could cover the shallow targets. Like I said, the pullbacks should be, and I say this with quotations, should be bought up right now by the dip buyers, because the price action again today, as of now, is nothing but bullish. Right? It's a large gap. Took out the 270 level, took out the downtrend line. But if they don't buy it, then there's always a potential it could be something similar back to 2008. Let me measure it. Actually, I'm curious. I told you that one was about a 10% rally from the low to high, from that divergent low. This one so far has been 9.13. So there it is. I cannot tell you what to do. I can tell you that there is a fair chance that this whole analog, these parallels to 2007 to 2000 up to this point back in 2008 could very well play out. They have played out so far that way. So just because I think that this is a different bear market, and we're not going to continue to mirror that bear market's path down, it's possible. I'm not going to trade against it if I see that start to happen. So that's it. That's what I'm looking at. We're at resistance. You want to keep it very simple. Resistance is resistance until unless broken. That was just an open order balance. And so if we can come back up here into the gap, the fact that we did have the pop this morning and the order balances, now technically there's our previous reaction high. We have to take that out. If we take that out, then it's going to run up to the next level. If that happens, and we run up to the next level, well, guess what? It's a further check mark for the bulls. Even if we get a reaction, which we probably would, meaning a pullback when we backfill the gap, that's what usually happens. If you backfill a gap, traders are going to step in. They usually step in, well, sometimes the gap is fully backfilled. Sometimes you briefly overshoot. I like to always take profits if I'm trading a backfill of a gap. Just shy of the top of it. But again, if we go up there, it's an additional check mark because we're getting farther and farther away from that whole whipsaw. Remember this, when you look at the weekly chart or the daily, that was the break of the previous lows from back in June, and now we've recovered it. So this makes this right now, as of right now, a bear trap, aka whipsaw. All that drop below, back tested it for a few days, but we took it back. To fail again is just going to be what happened in 2008. It will be uber bearish to see this recovery fail. To be safe, you have to take out the previous low, but even a solid move back down below that 269 level, I think will do the trick, and then I think that would seal the deal, a break between those previous lows. Right now, that is a less favored option. I hate to say it. Played out that way back then, but remember the way I work, just like I use that analogy, you bet the ponies, those odds are changing on the board minute by minute, second by second till the betting closes. So that's how it works for me. The odds are going to, the more we go up, the more resistance levels get taken out, the more likely we're going to get that decent bear market rally. There were enough indicators that I covered recently that had flipped, sentiment indicators and breadth indicators, not all of them. Not indicative of an end of a bear market, but indicative enough of a nice bear market rally. And again, what could a nice bear market rally mean? Easily 20%. 10, 15, 20, even 30%. We had that back in the last bear market. So, and I already gave you targets as to where we might go. We can look at the weekly charts. You have a downtrend line here on QQQ. You have your 200-day moving averages, which are like magnets in bear markets on rallies, and also objective shorting levels. You have a previous reaction high there. So there's plenty of potential if this market can get some traction here and hold this breakout. The S&P 500 SPY, you want to watch that one as well. That trend line's a little cleaner off the highs. In a big level, that was my first target back there. Near-term T1, there's your 200 days, and that would be, again, if and when we get there, about another 10%. But remember, we're already off the bottom. We're already up about 7-8% on the S&P. So, all right, guys, I'm doing a lot of talking. It's just there's a lot to see, and the most important takeaway that I can give you right now is that it's still anybody's game. But if you're a fan of football, Florida State's my team. We had a big game this weekend against Clemson. We started out the first quarter with a bang. They were ranked fourth. We weren't even ranked. We led. It looked like in the first quarter the game was ours. We pulled out ahead. We made the leading scoring. We're running right through them. And then it went the other way. They took a huge lead, but in the fourth quarter we really started to close the gap, and it's kind of that way right now. So what I'm doing is giving you an analogy. Right now the Bulls are in control. It's their game. They're leading. They've got this. Where does that start to? Where does the tide of the game shift? Well, if they fall back below the downtrend line, they can come in for a back test. And today's gap, see, that comes in together. So these are the levels you watch if you're looking to get out of longs. Let's say you're long, or you're looking to add shorts. Right now, I can't make an objective case to add any shorts. I'm more concerned about scaling out of the rest of my shorts and getting long as soon as possible if we're going to have a nice rally here. But there's today's gap. That would be a bad thing to see it taken out if we backfill the gap but then go down through it. Also the trend line there. And then I would just look at the, go back to QQQ. Look at those resistance levels I gave you the other day. We already took out the first one. We gapped right above the second one. We effectively gapped up to the third one. And so the way it works now is if we get back up in there, bullish. If we get rejected, we go down. Well, that former resistance at 270, about 272, becomes support, and that's where the bulls, quote unquote, should buy. And if they don't buy, well, bears get a little check mark there, okay? Bears might start taking, have control of the game at that point. Not complete control. They have to obviously take out 269. That would be an even bigger check mark. And just like, if you watch your favorite football team play, or if you played team sports, it's amazing when you get that kind of gusto, you get the momentum, the team's psyched up, and even an inferior team can often beat a superior team when they can get that momentum. It kind of builds on itself, but then when a team has their spirits broken, I've seen it just fall apart on the field, and so that's what would happen to the Bulls, in my opinion. It would be a knife through the heart of the Bulls if those things happen. But right now, this was a knife through the heart of the Bears. Play by play here. Bulls are in control. You guys know what to look for. I'm going to wrap it up here. And again, one last takeaway. It is earnings season. We're thick into it. There's plenty more to come this week, and even more in the next couple weeks here with all the big fangs, big tech reporting. That is going to determine, I think, the markets may flounder around. Even though this was a huge technical breakout, I don't expect a runaway thing here. So if you are a swing or trend trader, I can tell you, and you want to hold on right now, use a little bit looser stops for your short trades, you'll probably be okay, is my guess. Because right now, there are some red flags I'm seeing. I am not seeing Treasury bonds rally as much as they should be. They've been moving in lockstep with the stock market. That's a little bit of a red flag. Corporate bonds, which should be rallying. If the stock market's strong, this is showing people are shrugging off these earnings reports. All these companies, the banks at least, have been beating, but they always beat. They manage their earnings expectations. Everybody knows that. Rarely do you see big misses, especially in certain companies do a better job than others. But you're seeing a little bit of upside, and the charts are still constructive. But the fixed income market is really not, in my opinion, confirming this rally as much as it should be. A little bit of a lift in junk bonds, but they're at resistance, and so, like I said, I'm skeptical right now, and I'm just going to kind of, like I've been saying for the last couple weeks, earnings season, you shouldn't be heavy long or short right now unless you're just a gambler. Just expect whipsaws, and know that until the big fangs are out of the way, it is still anybody's game. Okay, I'm going to end it here. We'll take this day by day. I'll try to get some other individual trade ideas out for you, especially if I can find companies or industries or commodities, because then we don't have to worry about earnings. But what I was trying to say is find some companies that have already reported, or industries like financials will soon be out of the way. And then we can trade them purely on their technicals and not have to worry about earnings-induced gaps that can go against your position. So I'll work on that and get any other trade ideas out to you, but I'm not trying to force things right now. Personally, I'm keeping things light, and in doing so, if I don't see a lot of big opportunities, I'm not going to flood you with a lot of trade ideas. I like to be a little more selective on that. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.